Hi, it's Brenton Garren with ETF Trends and ETF Database, and today I'm joined by Mark Carlson, Senior Investment Strategist at Flexshares Exchange Traded Funds. Mark, as the search for yield moves into 2021 and hopefully a more favorable environment as optimism for COVID vaccines progress, what do you believe is the number one risk for investors?
So right now, the consensus appears to be for a vaccine uptake to begin in earnest in early 2021, with global economies returning to some further percentage of normal by mid 2021. Risk markets have been pricing in stimulus support from Congress and the incoming Biden administration and a continuation of the Fed's ZERP policy. This should help maintain equity valuations, support for levered corporations, and which would be a positive for credit spreads. But there are two different risk scenarios that can be anticipated for markets in 2021. The first would be slower recovery growth from an aggressive tax or regulatory reform packages, combined with a lack of fiscal support from a divided Congress. The post-COVID recovery would be stalled, and markets would likely sell off. This would be a negative for equities and other risk assets, but a positive for treasuries. The other risk scenario that could need to be considered would be a much faster uptake of vaccines and a speedy reopening to global economies, combined with a sizable fiscal stimulus. The effects of this double dose of economic fuel results in a spike in demand-driven inflation and a steepening of the yield curve as the Fed hangs on to its ZERP policy, allowing inflation to run hot. Higher inflation expectations would be negative for risk markets and for bond prices. In this environment and in the risk cases we see possible, we at Flexshares and Northern Trust Asset Management believe that high yield offers potentially attractive total return opportunities versus other asset classes. The Fed is likely to continue to support markets during adverse conditions through low rates and through the remaining COVID-related market support programs. And while higher inflation expectations have a negative effect on bond prices, the high yield sector has a lower duration and therefore less interest rate sensitivity than treasuries or investment grade corporates, offsetting some of this downside risk from rising consumer and business prices. The versatility of high yield makes it a useful tool in the pursuit of yield in investor portfolios.
Mark, we've seen a significant recovery in high yield spreads and yields. In fact, the yield on the Bloomberg Barclays US High Yield Index recently reached its lowest yield ever recorded. Is there still value to be found in high yield?
Well, it's true that yields on many high yield indices are near the lowest levels ever experienced. However, so are most interest rates, as the global economy currently faces over 16 trillion in global sovereign debt trading at negative interest rates. We believe that there is still value in high yield, both in the form of interest rate carry, that being the higher monthly income derived from higher credit spreads, and from price appreciation through opportunities to employ quantitative analysis methods to identify and utilize factors such as value and quality to identify insecurities that may see an improvement in their credit spreads. There exist opportunities across many credit levels in high yield to uncover value in companies that the market is valuing the company's debt below where the true risk characteristics warrant valuation. We believe we have created a proven quantitative methodology to systematic investing with fixed income factors that will potentially yield superior long-term results versus high yield strategies that may just be based solely on nominal yield maximization or beta allocations.
And finally, how has Flexshares approached systematic investing in high yield fixed income investing through the Flexshares US High Yield Value Scored ETF?
Well, Flexshares has worked with the quantitative research group at Northern Trust Asset Management, drawing on their extensive experience in factor investing in both equity and fixed income to design a strategy that seeks to use quant-based models to identify and maximize the value factor in high yield. Using quantitative analysis, the model can identify a bond's true value through fundamental and market inputs to arrive at a valuation defined by the default probability adjusted option spread to the risk-free rate. This truer measure of the valuation per level of default risk allows the Flexshares High Yield Value Scored Bond ETF, ticker HYGV, to utilize this value factor research to emphasize an optimal yield portfolio positioning. This is important because historical data shows that income from yield carry provides nearly all of high yield's long-term average returns. The Flexshares value factor allows HYGV to intelligently apply systematic investing techniques to attempt to maximize yield returns based on a default risk-adjusted value factor. With consensus expectations that the Federal Reserve will maintain its ZIRP policy for years, and given the investors' search for yield, Flexshares would encourage investors to review our systematic quantitative methodology for identifying superior value opportunities in high yield through our HYGV ETF.
Mark, thanks so much for catching up with us. Look forward to chatting with you again soon.
Thank you.